Let's look at how we can now measure the liquidity of a business. So remember, it's all about the business being able to turn on that metaphorical tap and have the cash there ready and flowing to pay debts when they fall due. So when we're measuring a business's liquidity, we're going to need the balance sheet. We're going to need the balance sheet because we need to be able to calculate the current ratio. The current ratio sometimes is also called the working capital ratio. Now, the current ratio simply compares the level of current assets a business has to the level of current liabilities it's obligated to pay. Before we go any further, this is the absolute trick to these questions. You must know your classifications. You must remember that your current assets, it's all about CIA. It's about cash, inventory, which is also known as stock, and accounts receivable, which can sometimes be called debtors. For our current liabilities, it's all about SAO. It's about our short-term loans, so anything under 12 months, our accounts payable, which is sometimes called creditors, and our overdrafts. In terms of the current ratio, it's got a pretty simple formula, which again they will give to you in the HSC. It's current assets over current liabilities. This time, our result is written as a ratio, so X to 1, and it means the business has X dollars of current assets for every dollar of current liabilities. So if a business has a current ratio of 5 to 1, it means the business has $5 of current assets for every dollar of current liabilities. Or if they had a current ratio of 0.6 to 1, it means the business has 60 cents of current assets for every dollar of current liabilities. So let's look at actually calculating this ratio. So the first way that they could give you the information you need to be able to calculate the current ratio is with a classified balance sheet. This is the dream. They've done all the hard work for you. So all you need to do is read off the balance sheet and identify how much you've got in current assets and current liabilities. So here they're telling us we've got $35,000 in current assets, and they're telling us that we've got $14,000 in current liabilities. So all we do is put it into the formula. We know that it's current assets over current liabilities, so it's 35,000 over 14,000, giving us a current ratio of 2.5 to 1. Or $2.50 of current assets for every dollar of current liabilities. Another way that they could give you this information, it's a classified balance sheet, but they just haven't given you the totals. So again, step 1, we just identify what are our current assets and what are our current liabilities from the balance sheet. So we know that our current assets are going to be our accounts receivable, our cash, and our inventory. And our current liabilities are going to be our accounts payable and our overdraft. So all we then do is use the formula to calculate the ratio. We know that it's current assets over current liabilities. This time we've got 4,000 in accounts receivable, 3,000 in cash, and 4,000 in inventory over our current liabilities of $5,000 in accounts payable, $2,500 in our overdraft, giving us 11,000 over 7,500, or a current ratio of 1.47 to 1, which means the business has $1.47 of current assets for every dollar of current liabilities. Another way that they could ask this question and make it slightly more challenging is to give you a balance sheet, which again is classified, but this time they've actually left out one of the figures that you need to be able to calculate the ratio. So all we do is add one extra step. Step 1, we need to find the value of stock, or we know stock is another word for inventory. All we do this time is use the accounting equation, which we know is assets equals liabilities plus owner's equity. So we start with the side of the balance sheet where we've got all the figures. We know that our liabilities is going to be our current liabilities plus our non-current liabilities, which in this case is going to be $110,500. We know that our owner's equity is going to be our capital plus our net profit, which in this instance is going to be $35,500, giving us a total for this side of the balance sheet of liabilities plus owner's equity of $146,000. That means that our total assets have also got to be $146,000. We know that we already have $143,000 in assets, so therefore our stock has got to be $3,000. Step 2, this time we just need to work out how much we've got in current assets and current liabilities. We know that we've got $21,000 now in our current assets because we've got $15,000 in cash, $3,000 in accounts receivable, and another $3,000 in stock. In our current liabilities, which we already had to begin with, we've got $5,000 in accounts payable and another $5,500 in an overdraft, giving us $10,500. Step 3, we just put it in the formula. Current assets over current liabilities, which is going to be $21,000 over $10,500, giving us a current ratio of 2:1, or $2 of current assets for every dollar of current liabilities. The most challenging way that they can ask this question is just to give you a list of accounts. It's actually not any more difficult than any of the other ones, it's just really testing, do you know your classifications? So step 1, you have to identify which of these accounts are going to be current assets and current liabilities. Ignore everything else. So we know that our cash is going to be a current asset, as is accounts receivable and inventory. We know that accounts payable will be a current liability, and the only other current liability there is our overdraft. Step 2, we just use the formula as before. So we know it's current assets over current liabilities, which in this case is going to be our $20,000 in cash plus our $12,000 in accounts receivable plus our $8,000 in inventory over our current liabilities, which is $15,000 in accounts payable, $7,000 in overdraft, giving us a total of $40,000 of current assets and $22,000 of current liabilities, or a current ratio of 1.82:1, which means that the business has $1.82 of current assets for every dollar of current liabilities. So in summary, we know that liquidity is a key financial objective of the business, and it's all about being able to pay short-term debts when they fall due. To be able to measure and assess liquidity, we need to calculate the current ratio. To calculate the current ratio, we're going to need information from the balance sheet. And remember, the only trick to these questions is, are you able to correctly classify and identify your current assets and current liabilities? So make sure you learn your acronyms.